How do your regular monthly payments affect your ability to buy a home? This is going to depend on how much of your monthly income is going to make those payments. When thinking about buying a home, the relationship between your monthly income and your monthly debt payments is known as the debt-to-income ratio, or D.T.I. This is something that can have as much or more importance when planning to buy a new home as other factors like your credit score. Different mortgage loans have different standards regarding how high a percent of someone's monthly income can be used towards payments of debts. These limits depend on a lot of different things. One example could be if there are two people applying for a loan and everything else is the same, except one happens to have a higher credit score, the individual with a higher credit score might be able to qualify for a home loan with a higher debt-to-income limit. There are two different ways to look at that debt-to-income ratio. These are known as the front-end ratio and the back-end ratio. That front-end ratio looks at the proposed monthly housing expense, which would include the principal and interest of the loan, homeowner's insurance, property taxes, etc. The back-end ratio includes the front-end ratio expenses, plus all other monthly debt payments, such as credit card payments, personal loans, student loans, and so on. The standards for front and back-end ratios differ between the various types of mortgage loans, FHA, conventional, VA, USDA, and the like. The debt-to-income ratio for mortgage qualifying purposes does not include all of your monthly recurring expenses. As its name suggests, only your monthly debt payments are included in the calculations. Your payments for things like utilities, auto and health insurance, streaming services, meal delivery services are not included in the figures for debt-to-income ratio. The other side of the equation is centered on your monthly income. When thinking about income, for this purpose, the number to use is the pre-tax income amount. Make sure to keep this in mind because this amount can be quite a bit higher than your final paycheck amount every month. Let's look at a real quick round numbers example at all of this math. Let's say that the person applying has a monthly pre-tax income of $5,000 a month. The proposed monthly house payment breakdown is $1,000 for principal and interest, $200 for property taxes, and $300 for homeowners insurance, which makes a total of $1,500 for monthly housing expenses. That would give a front-end or housing expense ratio of 30%. This same person has $250 a month in student loan payments, $400 a month for a car payment, and $350 a month in credit card payments. This person would have a back-end or total debt-to-income ratio of right at 50%. Debt-to-income ratio can play a big role in getting qualified to buy a home. Remember, if you wouldn't qualify for a loan by one set of standards, it is possible that you would qualify with a different loan type. Be sure to explore all of your options when looking to finance your home purchase. If you want to check in on what type of home loan you qualify for, please reach out. I'm here to help in any way that I can.